Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 37 is Equity Portfolio Management Strategy. Before going to discuss about equity portfolio management strategies, let us know which are the concepts that we discussed in the previous class. We have discussed about bond portfolio management strategies in detail in the previous class. The learning objective of the chapter is to provide an overview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. After attending this session, the students will be able to explain or understand the equity portfolio management strategies. What are the different types of equity portfolio management strategies? So we have four different strategies. So we are going to term it as long only. The other strategy is cash buffer. The third strategy, absolute return. The fourth one is market neutral. Dear students, let us understand these equity portfolio management strategies individually in detail. The first one is long only. This is one type of equity portfolio management strategies. This strategy is what most people think of when investing in equities. It is when you buy shares with the intention of profiting from an increase in the share price and or payment of dividends. However, beyond this, there is a huge range of strategies investors can use, such as active reverse passive management, equity size, small cap versus large capital, market sector, resources versus industrials versus biotech, etc. Investment style, value investor versus growth investor. Portfolio concentration. Some managers might hold just 10 stocks while others will hold over 100. Cash levels. Some managers are always nearly 100% invested while others can hold up to 100% cash depending on their outlook. Holding periods. Some managers take a 5 years view on the companies they buy, while others employ trading strategies and may hold only for the short term. Cash buffer. There is another strategy called cash buffer. This is an extension of the long only strategy which firm use to categorize managers who almost permanently carry responsible levels of cash. Some investors don't like managers holding high levels of cash as they believe they are being charged management fees for no benefits, or that the individual investor should control the overall level of cash in their portfolio and expect the managers to be fully invested. While firm can appreciate this point of view, firm believe that if a manager can continuously outperform their benchmark while holding an average of 50 while holding an average of 15% or more in cash, then this is a wonderful achievement. Holding additional cash allows the manager to act quickly on opportunities that arise, particularly after a market fall, and usually these managers have lower volatility as well. Shorting. To understand how absolute return or return and market neutral strategies work, it is important to understand what shorting is. A short sale occurs when the manager borrows shares from their prime broker, usually an investment bank, and sells the shares to generate a cash proceed. As the manager has borrowed the shares from someone else, they are required to return them at some time in the future. To close out the transaction, the manager must buy back the shares on market and return them to the prime broker. Absolute return. Before that, we have not yet concluded this, and the managers makes a profit if the price of the shares declines in value between the time the manager sells the shares and buy them back again. The manager makes a loss if the value of the share increase over this period. As an example, if a manager borrows 100 AAA shares and sells them for $1 each, they generate a cash proceed of $1. If in 1 month time the share price has fallen to 0.80, the manager can buy the 100 AAA shares they had borrowed on market for $80 and return the shares back to the lender. The transaction is closed and the manager has made a profit of $20, sold the shares of $100 and repurchased them back for $80. Conversely, if the share price had increased to $1.20, then the manager would have lost $20. The above example ignores the borrowing cost you need to pay the prime broker to borrow their shares. Trading cost and potentially dividends that need to be accounts for if the company pays one during the shorting period. Shorting can be a great way to add additional value to a portfolio, particularly when markets are falling and you might appreciate it most. However, it does introduce some risk factors. Markets and to go up over time, and thus in any strategy involving shorting, the manager is to some degree swimming against the tide. It is a riskier strategy than the usual long only and requires a significant manager skills to execute it well. Transaction cost, borrowing cost, and dividend reimbursement mean it can be costly to hold a short for an extended period, and this can eat into profit. Absolute return. Absolute return strategies are sometimes known as long short strategy. It involves the manager purchasing shares long strategy that they believe will increase in value while at the same time shorting shares they believe are overvalued and will fall in value. When done, this strategy can produce outstanding returns if the long portfolio increases in value and the short portfolio decreases in value. Obviously, if the opposite occurs, it can magnify your loss. Like the use of the shorting increase the overall leverage of the portfolio. Absolute return managers often quote both the gross and net exposure of their portfolios. As an example, if a portfolio was 100% long and 30% short, this would translate to a gross exposure of 130%, 100% plus 30%, and a net exposure of 70%, 100% less 30%. The gross exposure is an indicator of leverage in the portfolio for every $1 of equity invested in the fund. You have exposure to the market of $1.30. As with any leverage, this can magnify the against and losses. Net exposure is an indicator of how much market or beta exposure the portfolio has In theory, if the market falls and you have a net exposure less than 100%, the portfolio should fall by less. In practice, it obviously very much depends on what shares you own long and short and what the reason for the market falls was. Like the long only managers, absolute return managers can use all the same strategies for managing their portfolios. However, the absolute return managers also have the following additional factors to consider. Level of long and short position. This can range from conservative, say 7%, 70% long and 30% short, to aggressive 200 long and 100 short. Market neutral. Market neutral. This is a further extension of the absolute return strategy. With a market neutral strategy, the manager has an equal amount of long exposure as short exposure. For example, they may be long 100%, short 100%, resulting in a gross exposure of 200%. However, they may be long 100%, short 100%, resulting in a gross exposure of 200%. However, net exposure of 0%, hence market neutral. The strategy makes a profit if the long profit portfolio outperforms the short portfolio. Often trades are organized in pairs. Pairs are typically in the same sector, and the manager buys long the company they believe is relatively undervalued and sells short the company they believe is relatively overvalued. For example, they may go long BHP and short ROI in equal proportions. It is called market neutral because if resource stocks all decline or increase by 5%, then this market movement is cancelled out by being equally long and short in the same sector. This session can be summarized. These equity portfolio management strategies involve using historical methods. This type of manager will make industry and security bets in their portfolio weightings, moving into defensive stock and cash in overvalued markets and weighting stock and industries that are relatively attractive. Dear friends, we have a few multiple choice questions to understand this concept very well. Number one is buy shares with the intention of profiting from an increase in the share price and or the payment of dividends is called option A long only, option B short only, option C time only, option D save only. What could be the answer for this? The answer is option A long only. We have another question. Absolute return strategy are sometimes known as dash. Option A medium strategy, option B long strategy, option C short strategy, option D long short strategy. What could be the answer for this? The answer is option D long short strategies. Third question. With a market neutral strategy, the manager has an equal amount of long exposure as dash. Option A short exposure, option B long exposure, option C medium exposure, option D average exposure. What is the answer for this? The answer is option A short exposure. We have another question. A dash occurs when the manager borrows shares from their prime brokers, usually an investment bank, and sells the shares to generate a cash proceed. What is that? Option A short sale, option B profit, option C loss, option D cost. What would be the answer for this? The answer is A. Option A is the answer, short sale. The last question says, holding additional cash allows the manager to act quickly on opportunities that arise, particularly after a market fall. And usually these managers have dash as well. The option higher volatility, lower volatility, average volatility, critical volatility. What could be the answer for this? The answer is lower volatility. Dear friends, there are so many references are available and books are available to understand this particular concept, that is equity portfolio management strategies. You can go through multiple resources are available on equity portfolio management strategies in order to understand these concepts very well. And thank you very much for giving this opportunity, and thank you one and all. Wish you all the best and good luck.